History doesn't repeat, but it sure does rhyme, and that's pretty much how every single stock market crash goes. This $1.2 million count, yeah, I've been making a lot of money lately, but it's probably going to take a hit. Unless I position myself right now to capitalize if the market does take a hit, yes, you can make money if the market goes down. Of course, you can make money if the market goes up. So this video is going to outline the good, the bad, and the ugly of the economy right now. And then towards the end of the video, I'm going to show you inside of this account for the exact tickers that I am buying right now that will make money whether the market goes up or down. This is a great video if you're scared that the market's a little bit hot, maybe you think it might take a dip. I think there's a lot of signs out there pointing that we will take a dip. I'm going to prove it to you in this video right here. So let's dive in. So if we just look at the typical surface level data that most people look at, they're going to say, oh, the US economy grew at 3.8% in the second quarter, significantly stronger than previously reported. Just by looking at that, sure, that looks pretty bullish for the market. Then if we go to the next one, US consumer spending powers ahead in August as inflation is picking up. So yes, this part is maybe a little bit of a problem, but people are spending money. If they're spending money, that means that they have money. That means the economy is okay. And another key thing here is like initial jobless claims. Most people are going to say, oh, initial jobless claims are going down. There's less people that are filing for unemployment. That means the economy is good too, because people simply aren't getting laid off. People are not getting fired. And another thing, core inflation held steady at 2.9% in August as expected. So this stuff pretty much points to the fact that the economy might not be in bad shape. And that is the whole point of this video. Typically, that is what happens right before a stock market crash. Everything looks good. Everything looks all rosy and looks beautiful out there until it doesn't. Like look right here, for example. This is in 2008 for the S&P 500, and we obviously know the stock market went down quite a bit, down over 57% from peak to trough. Now, the key thing I want to point out is this. Look at this gap up right here, just a little wick right here at the top that for whatever reason there was a bullish catalyst for the market and people were buying into the stock market at that level right there. This was a bullish time in the market. Market's going up, 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 and then it goes up until it doesn't go up anymore. And I know that sounds kind of like stupid to say, oh, the market goes up until it doesn't. But understand that it's not like the market was going sideways and then bam, it goes down 57%. The market was in this strong uptrend and then all of a sudden, bam, it just pretty much goes straight down, is what it seems like. So don't think that, oh, there's a lot of strength in the market. And I know the market's been going up a lot lately right now, that it's just going to keep going up, because it often looks great up until the last moment. And then all of a sudden, everybody flips like a pendulum and then it's all downhill from there. And again, I don't want to come off like I'm Mr. Big Bad Bear Brandon, but I'm just pointing you out the facts right now of what I'm seeing in the market. And I didn't even get to the key point yet in this video for what actually is probably going to cause the next downturn. We didn't even get there yet. I'm just showing you that things look good until they don't. Everybody's been a genius in the bull market the last few years, but I promise you, it's not always going to be like that. And then just to throw a little bit more fuel on that fire for 2008, it took over 5.5 years to fully recover from the great financial crisis. 5.5 years. If you bought that wick that we were talking about before, the little gap up, it would have taken you 5.5 years. Think about that person when they put in that buy order. They bought stock at the top of 2008 and they had no clue what was coming next. But there were signs, there were clues, there were hints that were coming through the ripples of the economy that point to, hey, maybe this is going to crash. Hey, Michael Burry, we all watched the video, The Big Short. There were signs, and there's signs right now too. I'm going to get to it in just a second. I'm not trying to get you to watch this video till the end. I just want to lay the foundation for what's really going on right now. So let's dive in a little bit more. So Jerome Powell, who's in charge of the Fed, they raise interest rates up and down to help support the labor market and of course try to stabilize inflation. He was talking about how interest rates right now are moderately restrictive and he's keeping the door open to more interest rate cuts. And if you look down here at this video, I'm not going to play it, but you could see the closed captions and the risks to employment are tilted to the downside. What Jerome Powell is doing right now is he's basically teeing up the stock market to realize, hey, inflation is not that much of a worry right now. We have a bigger problem with the economy potentially going down the tubes. And he realizes that the data right now that we're seeing might be pretty good. But dude, this is Jerome Powell. He's at the Fed. He gets so much data that we don't see in advance. And you saw how quick he flipped up. We're going to do flexible average inflation targeting, basically saying over time, as long as inflation gets down to roughly 2%, we're going to be okay. So you know from roughly 2010 to 2020, inflation was definitely below trend of the 2% target. And then recently it's above trend. So when you average that together, sure, we're closer to 2%. But that is Jerome Powell's out. He is giving that as an excuse to say, we're going to do an average inflation target because we know that the labor market and economy is going downhill kind of quick. So we want to start cutting to try to save that. This is his out to start cutting. And that's being reflected in the CME Fed Watch tool, which basically projects how many interest rate cuts we're expected to get. So I selected the December 10th of 2025 meeting, and you could see that right now we're at 4 to 4.25%. Basically, what this means is this. We have a 3.4% chance of staying at the same interest rate range, basically means no interest rate cuts. We have a 33% chance of getting 25 basis point interest rate cut, and then we have a 63% chance of getting a 50 basis point cut by the end of the year. So basically what that would mean is you can see where my cursor is. October 29th, we'd probably get 25 bips, and December 10th, we'd probably get 25 bips. So that would put us in this range right here, which is the most likely scenario being priced in. Yes, interest rates going down are good for the stock market overall and good for the economy, but I have to show you a chart that kind of goes a little bit against that. So take a look at this chart. Is an accommodative Fed bullish for the stock market? Actually, it might be the opposite. So if we look at what happened in 1999 where the stock market fell 51%, look at what happened with interest rates. Look at what happened in 2008, market down, interest rates down. And there's a reason for this. Because the Federal Reserve knows that they have to cut interest rates when things get kind of crappy out there because they don't want the dips to be as deep. Maybe right here, this 51% crash would have been 60% or maybe even more if they wouldn't have cut interest rates from roughly 6% down to almost like 1%. Again, in 2008, we went from roughly 5.5% down to basically 0%. Maybe this dip would have been a lot deeper if the Fed wouldn't have done that. So the Fed is usually laggy to what actually happens. Typically, the stock market goes down and then they start to cut interest rates. So Jay Powell is starting to cut interest rates right now, but he might be too late. And we all have seen all the stuff that Donald Trump is saying, how he's too late, Powell, this and that. But to be honest with you, he probably is going to be too late because it's not like you cut interest rates and then immediately the economy is just going to snap back like that. It takes time for this stuff. The Fed is acting on a very laggy basis with pretty much everything that they're doing. So that's definitely something to understand. But this chart right here, this is the one that's the whale in the room. Let me get myself out of the way here because this is what really matters for the stock market to go up or down if it's going to crash or keep going higher, whatever it may be. All the things that I already presented so far in this video, it's just showing you the bullish side of the economy and the bearish side of the economy also. But the economy is starting to crack and valuations are hot. You guys know that I've been talking about on YouTube and X for a while now that valuations in the stock market are running a little bit hot. And this chart basically describes that. So it's a 10-year chart here on the bottom. The lighter line is the S&P 500. And the darker line is the forward earnings per share of the S&P 500. So the number one thing that moves the price of a stock in the long term or an index, really anything, is what the earnings per share do. That's the profits of the companies. Now, the S&P, it's just the profits of 500 different companies put into this, but it's really the same thing. Now, my point is, in the long term, these lines should pretty much move in tandem together. Yes, the stock market will get a little bit irrational, go to the downside of earnings per share. Maybe it'll get a little bit irrational and go to the upside of it. Downside, upside, you get it. Typically, what happens is the market always reverts to the mean. That is the mean line of earnings growth. So you could see right here, where is our earnings per share in relation to where is the stock market? You could see this gap right here that the stock market is really quite a bit higher than what the actual earnings per share are right here. So if we just say the stock market's going to fall down to where the earnings per share line is, go down to here, go to the left, we're looking at roughly a $5,500 S&P 500. Right now, we're on the way to potentially $7,000 for the S&P. So it could be a decent sized correction that we actually get. Again, I'm not saying it's going to be a full-blown crash, but simply by looking at this chart, was it a good time to buy right here when it was a little bit above the earnings per share growth, or a better time to buy right here when the S&P was below the earnings per share growth? Good time to buy here, look at the future returns. Decent time to buy right here, look at the future returns. That is how the stock market works. Typically, when you buy up here when things are expensive, your future expected returns might look something like this. So there is a way to capitalize on that. I'm going to show you inside my portfolio in one more minute. I do have to show you another chart that really builds on that just a teeny bit. I'm not going to talk about it too much here, but basically saying that the price earnings ratio level of the market that we're in right now is similar to where this green line is. And then it shows you what the subsequent 10 years do in the market for the returns going annualized. So every single year going forward, average together for the next 10 years, what are our expected returns? When the PE ratio is hot, you can see that the future expected returns are kind of poor versus when the PE ratio is roughly 11, yeah, the future expected returns are probably pretty good because the market's already cheap. You're starting at a cheap level, it could go up quite a bit. But when you're starting on a higher level that we're at right now, you got to be very careful. Now, the play that I have set up in my main Charles Schwab account, honestly, I think it's going to work out pretty good. There's no guarantees on anything, and obviously, it's not financial advice. So, let me pull this up for you and show you. I have a couple things going on in my Schwab account. I do have two accounts within Schwab. And you can see that right now I have a bunch of Triple Q, VOO, Tesla. Like, we're up pretty good on all this stuff right now, up over $400,000. But the key thing that I want you to focus on is BLV down here. It's roughly 7% of this account, but I have another account that I'm going to show you in just a second. Now, what BLV does is BLV tracks the price of bonds. So if we think that interest rates are going to go down, maybe because Trump is going to make the Fed cut, maybe he's going to appoint someone that is going to cut, the price of BLV share price will go up because interest rates and bond prices go opposite of each other. So if bond yields go down, the price of BLV will go up. So BLV right now, I'll just click on it. It's roughly $70 per share. This $70 per share will go up as interest rates go down. Remember, they move opposite of each other. Yields down, price up. I know it doesn't really make sense, but just do a little bit of research on bonds. I'm not going to really go into it for this video. Now, you can see the allocation over here, what they're pretty much holding. A lot of government bonds, a lot of corporate bonds. At the time that the market's a little bit hot, we're going to fetch a decent sized yield. We're capturing like 5% per year. I know it's not a lot. This isn't like a play to capture a yield and sit there forever. This is a play to hedge downside. If the market goes down, if the Fed has to cut, if the economy cracks even harder, the Fed will cut. And when they cut, the price of BLV will likely go up. So this isn't just a hedge on valuations being a little bit hot and maybe the stock market might take a dip down. This is a hedge on, obviously the economy crashing, the stock market crashing, Jerome Powell getting fired, and some other Fed goes in there and cuts. Basically, it's just a hedge in the market at a time that things are hot. It kind of makes sense to do this for a small percent of your portfolio. Again, I have BLV in this account. This is my IRA, and I have VCLT, which is basically like it's more corporate bonds, but it's a very similar play. If interest rates go down, the prices of these ETFs are going to go up. The share price right here will go up. The share price right here will go up. And there's room to capture decent capitalization here. So there's one last thing that I really want to hit on crystal clear with you guys. And it's the fact that maybe the market crashes, maybe it doesn't. But one thing that I do feel very confident doing is stocks and options. There's still a lot of things that we could capitalize on right now. Maybe the overall market's expensive, but there's individual companies that I'm buying call options on, I'm selling put options on. And then some of the stuff that's a little bit hot, maybe I buy puts, maybe I sell calls. So either way, no matter what the market's doing, there is a way that you could capitalize on it. And that's why I feel like the stock market, it's like one of the best games of life in the entire world because opportunity is right here at our fingertips. All we have to do is spot it, find it, capitalize on it, and really just make money doing it. That is the whole point of this YouTube channel. That's what I'm here to do is just share with you guys my journey, what I'm looking at, what's going on, the whole meal deal. So if you get value from these videos, definitely drop a like and subscribe. It really helps out the channel. If you want to do my stocks and options course, click the link below. You could get in for free for the first 7 days. If you don't want to do any of that, watch this video right here. I think you'll get a lot of value from it. I'll see you there.